So imagine you're the CEO of a major tech titan,
Okay, I'm with you.
and you've just spent billions of dollars securing the absolute best silicon chips on the market.
Right, the really high-end stuff.
Exactly. You are building this state-of-the-art artificial intelligence supercomputer. The facility is built, the servers are racked, and you're just, ready to train the next generation of AI.
Sounds like a massive operation.
It is. But then you call the local utility company to plug it all in, and they tell you, sorry, we actually don't have enough electricity on the grid for you. Come back in 5 years.
Which is wild, but that isn't just a hypothetical scenario anymore.
Not at all.
For companies building these massive data centers today, grid constraint is, it's arguably the single biggest bottleneck to AI deployment right now.
Welcome to Market Pulse Daily. Today we are looking at some fresh research from August 9, 2026, and unpacking a company that is entirely focused on solving that exact power bottleneck.
Bloom Energy.
Yep, Bloom Energy. And honestly, if you are watching the AI boom or investing in tech or just following the energy sector, you have to pay attention to this case study.
It is genuinely fascinating. And before we get too deep into the wild price action, we should mention that today's show is brought to you by StockOracle.
Right. StockOracle is an AI-aided stock research platform. You can use it for fundamentals, valuation estimates, moat analysis, bull and bear insights, all that good stuff.
There's actually a special 14-day trial link below in the description if you want to check it out.
But just as a quick heads up, that is an affiliate link, so we might earn a commission at no extra cost to you.
And of course, StockOracle is not financial advice. It's not a buy or sell recommendation or a trading signal service.
Right, and AI insights can be incomplete or delayed, so always make sure to verify the facts yourself.
Definitely. So looking at the data on Bloom Energy, the paradox here is just staring us right in the face.
It really is. Like, they've had a staggering 52-week run. The stock shot up almost 500%.
500%. That's just a massive move for a $64.6 billion company.
Exactly. They're reporting absolute blowout earnings, and yet the stock recently plunged into this 13-week correction.
Right, dropping over 23% to trade around 219 right now.
So the big question is, how does a company doing everything seemingly right throw off so many yellow warning flags?
Well, that tension is the core of our analysis today, because this goes far beyond just one single stock.
Yeah, it's a much bigger story.
What we are really analyzing is this massive secular tailwind, the insatiable power demand of AI data centers colliding head-on with extreme market valuation.
And a deeply divided investor base.
Exactly. It's a market trying to price perfection.
Okay, let's unpack this.
Yeah.
Because to understand this wild valuation, we really first have to understand the actual technology.
The mechanics of it.
Yeah. So Bloom Energy makes these things called solid oxide fuel cell.
Right.
The research describes them as on-site, fuel-flexible power generation systems. But I have to push back a little right here at the start.
Oh, how so?
Well, when you and I talk about artificial intelligence, we usually talk about software, right? Or algorithms or semiconductors.
Sure, the digital side of things.
Yeah. Industrial power generation just seems, entirely out of place in that conversation. Why is a fuel cell company suddenly the darling of the AI world?
Because the physical reality of AI is, it's finally catching up with the digital hype.
Meaning what exactly?
Meaning training these massive language models requires an amount of electricity that is genuinely difficult to comprehend.
Like, how much are we talking?
We are talking about individual data center campuses that draw the same amount of power as an entire mid-sized city.
Oh, wow. That's massive.
It is. And crucially, they need that power to be always on, like 100% uptime.
Because if it flickers...
Exactly. If you're training a multi-billion parameter model and the power dips for even a fraction of a second, you can literally corrupt weeks of computational work.
So you can't just throw up some solar panels and hope for a sunny day?
Right. You cannot rely on intermittent sources like wind or solar without massive, wildly expensive battery backups. And like we said earlier, the traditional public grid just cannot handle this concentrated surge in demand.
So Bloom's solution operates what they call behind the meter.
Yep, right on site.
But we need to explain how this actually works, because I was picturing, like, a giant diesel backup generator sitting in a parking lot.
Oh, it's very different from that.
Right. From what I understand, a solid oxide fuel cell doesn't actually burn anything. It uses an electrochemical reaction.
Exactly.
So you feed it a fuel, like natural gas or biogas or hydrogen, and it strips the electrons off the fuel without combusting it,
It's essentially a chemical battery that never dies as long as you keep feeding it fuel.
which is kind of mind-blowing.
And that mechanism is the entire value proposition. Because there's no combustion, it is significantly cleaner, far more efficient, and incredibly reliable compared to, say, traditional turbines or diesel generators.
So the data center gets its own dedicated baseload power source.
Exactly. Completely insulated from grid blackouts or public utility constraints.
And the financial numbers from their Q2 2026 blowout just show how desperate the tech industry is for this exact solution.
The growth metrics are completely staggering.
Yeah, let's talk about those. They reported a record $1.07 billion in revenue for the quarter.
Just massive.
Right. Just to put that in perspective for you listening, that is a 56.5% year-over-year growth rate.
What's fascinating here is that this wasn't a one-off fluke. This was their 7th consecutive earnings beat.
7 in a row. That's serious execution.
It is. But the metric that really stands out isn't just the top-line revenue. It is the sheer operating leverage they are demonstrating right now.
Yeah, the profitability jump.
Exactly. A year ago, their operating income for the quarter was $28.6 million.
Okay.
This quarter, it skyrocketed to $239 million.
Wow. Which tells me their manufacturing has reached a massive turning point, right?
Absolutely.
Like when your revenue grows 56%, but your operating income jumps by over 700%, your fixed costs are finally being absorbed.
They aren't just selling more units. They've achieved the economies of scale needed to produce and deploy them much more efficiently.
The profit margins are just expanding beautifully.
Yeah, and they are backing that up with a fortress of a balance sheet, too.
Oh, yeah, the cash pile.
Right. They ended Q2 with $2.67 billion in cash against just $31 million in short-term debt.
That is a very comfortable ratio.
Very. Furthermore, their backlog of orders increased 44% year over year. They have nearly $1 billion, $935.4 million, be exact, in contracted revenue just waiting to be fulfilled.
But, that backlog actually brings up a pretty glaring operational challenge.
How so?
Well, building out these massive on-site fuel cell installations for data centers is incredibly capital intensive. We're talking about heavy industrial infrastructure here.
Oh, for sure.
If every new customer requires Bloom to front the cost of building these systems, Bloom would burn through that $2.6 billion cash pile incredibly fast.
Right. They need a way to finance and scale these huge projects without crushing their own balance sheet.
Exactly. And that capital constraint is exactly why their strategic partnerships are arguably the most vital part of their business model today.
The technology is impressive, but their financial structuring is what is actually allowing them to scale at this speed.
So let's dive into the Brookfield asset management deal because it completely changes the math for the customer.
It really does.
Like, if a data center operator wants to adopt Bloom's systems, paying hundreds of millions of dollars in cash upfront is a massive barrier to entry.
Most companies just can't stomach that hit.
Right. But Bloom and Brookfield have set up this $25 billion financing facility.
$25 billion?
Yeah. I view this almost like a luxury car lease.
Okay, I like that analogy.
Yeah, so if you want a $200,000 car, paying cash is impossible for most people. But if a financial backer buys the car and leases it to you for a monthly fee, suddenly you have the keys.
Brookfield acts as that financial backer for Bloom's customers.
Exactly.
If we connect this to the bigger picture, Bloom isn't just selling hardware anymore. By bundling their fuel cells with Brookfield's massive capital pool, they are essentially offering energy as a service.
Which is brilliant. The data center operator avoids a massive upfront capital expenditure, turning it into a predictable operating expense.
Right. Brookfield gets a steady, long-term yield. And Bloom gets to recognize the revenue and accelerate their deployment without taking on the debt themselves.
It creates a massive moat.
A huge one.
Because a smaller competitor might develop a great fuel cell, but if they don't have a $25 billion war chest to finance their customers, they just can't compete for these hyperscaler contracts.
Not a chance. And when you combine that financial moat with their expanded Maytac AI power partnership...
Oh, right, the one that gives them direct integration with the server racks.
Exactly. Bloom is basically dominating this specific niche by offering the technology, the deployment, and the financing all in one neat package.
So, okay, we've established a nearly flawless fundamental picture here.
Right. Record revenue, huge margin expansion, a massive cash pile, brilliant financing structure.
Which naturally leads to the multi-billion-dollar question. If the engine of this company is running perfectly, why on earth is the stock down 23% from its June peak of 351?
Because the market is forward-looking, and right now the market is grappling with a valuation that leaves absolutely zero room for error.
It is the textbook definition of being priced for perfection.
It really is.
Here's where it gets really interesting, because the valuation metrics in the data today are genuinely hard to wrap your head around.
They are definitely extreme.
Let's talk about the trailing 12-month PE ratio, the price-to-earnings ratio.
Okay.
For a healthy, established tech company, you might see a PE of, 30, maybe 80 if it's growing really fast.
Sure.
Bloom Energy's trailing PE is listed at over 10,000.
Yeah. A number that high often confuses investors, but it highlights a specific phase in a company's life cycle.
How do you mean?
Well, when a company is transitioning from losing money to just barely making a profit, its net earnings per share are often a tiny, tiny fraction of a cent.
Right.
Because the earnings, the denominator in that equation are so incredibly small relative to a $64 billion market cap. The PE ratio mathematically inflates to an absurd, almost meaningless level.
So it shows they are profitable, but the profits haven't yet caught up to the massive stock price.
Exactly. So investors have to look at forward-facing metrics instead.
And the research lists a forward price-to-sales ratio of 14.69.
Which is roughly 3 to 6 times the median for the industrial and energy sectors.
That's steep. If I'm an investor looking at a $64 billion valuation with a price-to-sales ratio of nearly 15, I have to assume that any minor hiccup like a delayed contract or a missed earnings target means this stock just falls off a cliff.
And that is the exact downside risk the market is trying to price in during this 13-week correction.
It makes sense.
When you factor years of flawless hyper-growth execution into today's stock price, the repricing can be incredibly violent if the narrative cracks.
Oh, absolutely. And our data today highlights several specific operational risks that could trip them up, right?
Right.
Starting with their supply chain.
Yeah, Morningstar has flagged lingering questions about Bloom's ability to actually source the materials required for these systems.
Which makes perfect logical sense. I mean, having a billion-dollar backlog of orders is fantastic for the stock narrative, but actually acquiring the ceramics, the rare earth elements, and the manufacturing capacity
to build those solid oxide cells fast enough to meet AI data center timelines.
Yes. It has to be a logistical nightmare. If the supply chain chokes, the revenue growth stops entirely, no matter how much demand exists.
Right. Furthermore, there is an ongoing debate among active institutional traders regarding the long-term durability of these systems.
Or they run so hot, right?
Extremely hot. Solid oxide fuel cells operate at very high temperatures. So the question being debated is whether these systems will require excessive maintenance or trigger massive warranty costs 3, 5, or 10 years down the line.
Oh, and if warranty claims pile up, that beautiful margin expansion we discussed earlier,
It could evaporate very quickly.
because no one knows for sure how these systems will age under the constant punishing load of a hyperscale data center.
Exactly. The market has a really hard time modeling the long-term cash flow with that unknown hanging out there.
And you can see that uncertainty directly in the stock's volatility. The metrics list a beta of 3.89.
And beta is a crucial metric here. It measures volatility relative to the broader market.
Right, so the S&P 500 has a beta of 1.
Exactly. So a beta of nearly 4 means Bloom Energy is wildly volatile.
It swings hard.
Very hard. If the broader market goes up 1%, Bloom could easily jump 4%. But if the market sentiment sours and drops 1%, Bloom could plummet 4%.
It is an incredibly high beta play. It just amplifies both the upside rewards and the downside punishments.
Which brings us to a really bizarre situation outlined in the research today, the great sentiment divergence.
Oh, yeah, this part is fascinating. Because when you have a company posting flawless earnings but trading at a terrifying valuation, people tend to vehemently disagree on what to do next.
The split here between institutional money and retail traders is incredibly stark.
Yeah, so on the institutional side, Wall Street analysts are largely defending the stock. Firms are keeping their bullish outlooks.
Right. They are looking at the 56% revenue growth, the Brookfield financing moat, and concluding that the premium valuation is justified by the dominant market position.
Yet the retail investor base has entirely jumped ship, like completely.
The retail sentiment trackers are ugly right now.
Yeah, the sentiment tracker on Reddit showed a very bullish score of 78 in early July. By late July, it had plummeted to a deeply bearish 18.
That is a total collapse in retail confidence in just a few weeks.
It raises an important question, though. Who actually has the right read on the company's trajectory?
Right, is it the institutional analysts modeling the long-term cash flows? Or the retail traders who often act as a more sensitive barometer for immediate momentum shifts?
Well, adding weight to that bearish retail sentiment is the behavior of Bloom Energy's own executives.
The insider selling.
Yeah, the data highlights insider selling as a major yellow flag. Over the last 90 days, there has been a net sale of 83,381 shares by insiders.
Now, you might be thinking, 83,000 shares for a $64 billion company is a drop in the bucket.
And you would be right. The volume itself isn't enough to actually move the market.
But the concern isn't the raw volume. It is the trend and the timing.
Right.
Executives sell stock for all sorts of benign reasons, paying taxes, buying property, diversifying a concentrated portfolio.
That happens all the time.
However, when you have a stock trading at nosebleed multiples and you see consistent net negative flow from the people actually running the company, it signals caution.
It suggests that the insiders themselves might feel the valuation is a bit frothy, choosing to lock in gains rather than hold for further upside.
And then you combine that insider trend with the unconfirmed overhangs mentioned in the data.
Right, the report notes the existence of a recent lawsuit and a short seller report.
We don't have the granular details of the allegations today, but honestly, just the shadow of a lawsuit and a dedicated short seller campaign makes market sentiment incredibly fragile.
Oh, for sure. When a stock is priced for perfection, it doesn't take much negative news to trigger an avalanche. If that short seller report gains traction, that 23% correction could easily deepen.
We basically have opposing forces at war with each other right now.
Yeah.
The secular AI tailwind and flawless execution on one side against extreme valuation, supply chain bottlenecks, and fragile sentiment on the other.
So, if you are listening to this and watching this story unfold, you need a roadmap. You need to know the actual trigger points over the next 3 months that will resolve this tension.
The absolute most critical event on the horizon is the Q3 2026 earnings report, scheduled for late October or early November.
Okay. What are we looking for there?
Well, Bloom Management raised their full-year revenue guidance to between $3.9 and $4.2 billion.
That's a high bar.
To hit that target, Q3 needs to be exceptional. We need to see if they can cross that $1 billion quarterly revenue mark again.
Got it. And if revenue growth decelerates from that 56% pace,
The market will likely punish the stock severely. The premium valuation demands accelerating growth.
but if they beat expectations and that billion-dollar backlog continues to swell, the current pullback will look like a classic buying opportunity.
Exactly. It is entirely about proving the Q2 growth wasn't just a pull forward of demand.
Are there any other catalysts to watch?
Another major one would be new hyperscaler contract announcements. Much of their current AI narrative is tied to major partners like Oracle and Mitek.
Right.
If Bloom announces a massive new contract with another major tech giant, say an Amazon or a Microsoft, it proves the demand is widespread and reduces their reliance on a concentrated customer base.
And for the technical traders watching the charts, our data highlights the 210 level as critical support.
Very critical.
The stock tested the 210 to 220 zone during this correction. If it breaks below 210 on heavy volume, the technical structure breaks down, which signals further downside risk.
Conversely, reclaiming the 240 to 250 zone suggests institutional buyers have absorbed the selling pressure and the correction is over.
So what does this all mean? Taking a step back, the overarching consensus we're seeing gives Bloom Energy a neutral outlook right now.
And given the evidence, that makes perfect sense. Bloom is a brilliant company executing flawlessly.
They really are. They have solved a massive real-world bottleneck for the artificial intelligence industry, and they have the financial backing to deploy their solution at scale.
But a great company does not automatically equate to a great stock at any price.
Exactly.
At 219 right now, it remains a high-risk asset carrying a valuation that demands sheer perfection quarter after quarter.
The reason this deep dive, this breakdown matters to you, whether you are actively investing in tech, studying the energy transition, or just trying to understand the AI boom, is that Bloom Energy is the perfect microcosm of the current market.
It really is.
It shows exactly what happens when a very real, massive technological shift hits extreme market hype. The underlying fundamentals have to sprint a marathon just to keep up with the sky-high expectations.
It is the defining dynamic of this era in tech. But, I want to leave you with one final thought to ponder, something that goes beyond stock prices and valuation multiples.
Okay, let's hear.
Early in our research today, it briefly mentions traditional grid power as Bloom's competitor.
Right, the public utility monopolies we all rely on.
Think about the broader implications of what Bloom is facilitating here. AI data centers are rapidly becoming the backbone of the modern global economy.
Sure.
If these critical facilities increasingly require their own localized off-grid power generation because the traditional grid simply cannot handle the load, we are witnessing a massive paradigm shift.
Wow.
Are we seeing the beginning of the end for centralized utility monopolies? If the most important companies in the world decide it's better to generate their own power on site, that fundamentally changes the architecture of how we electrify the world.
It points to a future of completely decentralized power, driven out of sheer necessity by the tech sector.
It is a fascinating concept to watch unfold.
There really is. So the data today suggests taking a measured approach. The underlying engine of Bloom Energy is incredibly powerful. But with the warning lights flashing on valuation and sentiment, it might be wise to wait for the Q3 earnings data before making a major move.
And as a reminder, if you want to run these valuation models yourself or track those technical support lines, don't forget to use that StockOracle 14-day trial link down in the description.
But again, always verify everything, as AI tools can be delayed or incomplete, and it is not financial advice.
Keep questioning the consensus and keep looking past the hype.
Thanks for tuning into Market Pulse Daily. Make sure you're subscribed, and we will catch you on the next breakdown.